Hi, and welcome to Buy Alerts Bonus. We'll be taking a look today at why IV matters, certainly in this current market environment with the VIX and multi-year highs since the COVID crisis, and more importantly, how to maybe take advantage of it. We're going to do a comparative on Amazon trades back from late August, the last time Amazon was trading at a similar, almost exactly the same price to yesterday. We'll take a look at a neutral trade, an iron condor trade selling out of the money call spread and put spread both, a bearish call credit spread selling an out of the money call spread to receive premium in, basically banking against a huge further rally in Amazon, a bullish put credit spread, same thing but to the downside, selling a out of the money put spread, bringing in money and positioning to be a buyer of Amazon on further weakness from here. And then the old standard, the covered call trades, how the big jump in implied volatility, meaning option prices became much more expensive, also sets up ideally for that. So let's jump in and take a look. First of all, here's the comparative time frame back from late August. Last time Amazon was trading right around that 170 level. Actually took a look on the close on Wednesday. As you can see, the stocks just absolutely ripped as we saw Wednesday during the day as the tariffs got put on hold here. We can also see implied volatility, which had reached the highest level by far of the past year. That's when we took a look at these trade comparatives, softened dramatically, a huge benefit to selling option premium in a defined risk way. All of the trades we're going to look at have defined risk, so you know when you put the trade on what your maximum loss can be. Also a much bigger cushion, much further for the trade to, in essence, go against you before you get in trouble, and a slightly shorter time frame. Last August, we're going to be looking at a 50-day expiration, and from basically Tuesday's close, taking a look at just under a 40-day expiration. So let's jump in and take a look, shall we? So here was the trade coming out, as we see, from April 8th on the close here. This is the iron condor trade, selling both an out-of-the-money put spread and a out-of-the-money call spread simultaneously. The strikes we sold, selling the 135 puts, hedging by buying the 130 put, selling the 205 call, hedging by buying the 210 call, so selling both of these spreads at the same time. Here's the trade down here, and receiving about $1.10 to $1.15 net credit on the trade. As you can see, the stock closed at 170.66. The downside cushion, in other words, how far Amazon could fall from 170 before our 135 put spread strike got in trouble, about 20%. Same thing to the upside, 34 and change as far as the upside before that 205 strike price would become problematic. So a nice 20% cushion for the stock to move up or down. IV at about 62, and the days to expiration only 38 days to expiration. The return on risk, which is simply figured the max loss on the trade, is 5 points because we have a 5-point wide call spread and put spread both. Only one of them will be in trouble at expiration. So our maximum loss, if you will, is 5 less that $1.14 credit received up front. So our maximum loss, $386 per each time we do it. Our maximum gain, $114. Simply divide those two, and you have roughly almost a 30% return on risk, making 114, risking 386. That was on Tuesday's close. Looking back to last August when we were at a similar price, Amazon basically parked at the same price, 170.80, right? That same iron condor, except I took a look at the 150, 145 put spread, right? So moving again much closer, 15 points closer on that. And the 190, 195 call spread, again, 15 points closer back then versus the 205, 210, 135, 130. So have less room for the stock to move against you before you got in trouble back then. Yet the credit on the trade was less than it was on Tuesday's close. Not even able to get $1 net credit on that trade, Why? Because implied volatility back then was under 30. Compare that to where it closed on Tuesday at over 60, basically a doubler. So that huge jump in implied volatility allowed you to get a bigger cushion on the trade as of Tuesday's close versus last August, right? 15 points on either side. Get a bigger credit, over $1 net credit to under $1 net credit, right? And days to expiration less. We are looking at just a 38-day expiration as far as Tuesday's close, 50 days to expiration as far as last August. So you have to wait longer to realize the gain too. So bigger cushion, less risk in essence, bigger credit, bigger return with less time, all sets up ideally for this sort of neutral trade selling this iron condor in Amazon. For those who are bearish, same thing here on the call spread. Took a look at it from Tuesday's close. The stock again at 166, virtually the same as that 170.80 level that we're comparing to it last August. That call spread, the 200-205 call spread, so about 30 points out of the money, right? Trading right around 85 cents net credit. The upside cushion on the trade, in other words, how much Amazon could move up before you got in trouble. Obviously, if Amazon moves sideways or down, trade works out beautifully, right? It can even move up 17% before it got in the money, so you have a ton of upside cushion as well. Why? Because that IV shot up to 49. Again, we're looking at that 38 days to expiration trade. So your return on risk, 5-point wide call spread, selling the 200 call, buying the 205, right? But receiving 85 cents. So able to make 85 bucks, risking 415, gives you just over a 20% return on risk. Very nice return on risk, especially considering you can have the stock move up 17% before the trade becomes problematic. Compare that to the last time Amazon was here last August. Again, the stock virtually the same price, 14 cents difference, right? A rounding error, 170.80. And now we're looking at the 190, 195 call spread. So 10 points closer to the money. So much closer to the money call spread, right? But only getting 56 cents before, and as far as Tuesday's close, able to get 85 cents. Same width, 5-point wide, but only 11% or so upside cushion, whereas yesterday or on Tuesday you had 17% upside cushion. Why? Because that big IV jump, right? IV back last August at 27. You can see IV exploded again, basically a doubler. So that sets up ideally again for that bullish out of the money call spread for those, or bearish out of the money call spread for those bearish on the trade. The return back then, just under 13%. The return, if you did it Tuesday, over 20%. And again, with a 10-point bigger cushion, right? A bigger, margin of safety by 10 points, right? And less time to expiration, 12 less days to expiration, 17% upside cushion versus only 11 on the bearish call spread for those bears out there. Same thing on the put spread. We'll take a look at it back then, right? This out of the money put spread, the 150, 145, chose that one with the stock again at 170.80. That put spread trading just around 40 cents. The downside cushion back then, about 12%, right? Stock was at 170.80. 150 is your problem area where it starts. IV back then about 33. And again, days to expiration, when we looked at it, 50 days. Your return on risk, right? Bringing in 40 bucks, risking 500 less that premium received of 40 cents. So risking 460. So 40 divided by 460 comes out to a little bit less than 9% return on risk back then. Now taking a look at the bullish put credit spread again, the stock virtually parked at the same price. The put spread we're looking at, again, 10 points further out of the money, 10-point bigger cushion, range of safety, right? So the stock has to drop an additional 10 points from our comparative last August to get in trouble. Yet the put spread is basically almost double the price. Why? This huge jump in implied volatility, now over 73, right? Back then we were looking at IV of 33. So this sets up ideally for that put spread, receiving 75 cents, 75 bucks, risking 425. Again, 5 points wide, less the 75 received. So that return on risk over 17%, right? Back then you were looking at basically half of that, 8%. So again, able to get further out of the money, a much bigger return or margin of safety with less days to expiration, 12 less days to expiration. Why? Because of this big jump in implied volatility. So for those bullish on Amazon as of, kind of the market malaise last Tuesday, this would set up ideally for a out of the money bull put spread. You don't have to be right. You just have to avoid being really wrong, right, by about 18% on Amazon stock. And then covered calls, right? Took a look at the most basic trade, and pretty much everyone is approved to do covered calls. So going back again to late August last time Amazon stock was here, the stock 170.88, right? And took a look at the slightly out of the money 175 call that expires 50 days out, and that was trading roughly about $5.70 or so, as you can see here. Here's the bid ask on the trade. You can see then the covered call, buying the stock, selling this call, right, would equate to about a little more than $165 you could pay, right? Downside protection by selling this call till you get in trouble, a little over 3%. And that 175 strike allows the stock to basically rally from your net cost, 165 to 175, 2% or so upside cushion on the trade. Again, 50 days to expiration. Return if called, if the stock is above 175 come expiration, your return a little bit less than 6%. The IV at the time 28. Now we can take a look at that covered call, right? The same strike price, less days to expiration, again only 38 compared to 50 back then. Stock at virtually the same stock price, but the price of that call, that 175 call, has more than doubled, right? So you're looking at a massive jump on that covered call. Now if you buy the stock, sell that call, you're looking at, getting right around $160 net cost. Why? That IV just exploded to the upside here. So your downside now, until you get in trouble, right, until you get to pretty much that 160-ish area, 6% from the current stock price, you're still leaving yourself 2.5% upside. And more importantly, because you brought in more money by selling that call, right, your return if called over 9%, right? If you looked at back then, under 6%, increasing your return dramatically, all because this huge jump in implied volatility set up ideally for a covered call trade. And if you want to get a bigger upside potential, right, sell a further out of the money call for a similar price to where it was last August, took a look going all the way out to the 190 call. That call trading just a little bit over $5, very similar to that call back here in late August that was trading just a little bit over $5. So very similar premium, but 15 points further out of the money, 15 points more upside on the trade. So you have that very nice upside on the trade. Your return if called, certainly very nice indeed, right? Because you have more upside gain potential on the stock. Your downside, virtually the same. You're covering about 3% pullback on the stock here, 3.29%. For those who were more bullish on Amazon, selling a further out of the money call spread for basically the same price as a closer to the money one with less days to expiration now versus then, makes a lot of sense. So I kind of put it all together here on a comparative. Here's that neutral trade, right, that iron condor. You can see the stock price virtually the same, 14 cents different. The iron condor, 19 cents better as of Tuesday's close versus back then, right? But the downside cushion on the spread as far as on Tuesday's close versus back then, you pick up almost 9% more margin of safety, more cushion to the upside and downside. Why? This huge jump in implied volatility of 32 vol points, massive indeed, right? And it's 12 days less to expiration, so you have less time, further cushion, able to get a bigger credit, your return increasing by almost 6%, all because of that jump in IV. Taking a look at the call spread, that comparative as well too. Stock obviously virtually the same price, but able to get almost 30 cents more on the call spread, even with 6% further out of the money on the call spread, right? The 200, 205 versus the 190.95. Again, 12 less days to expiration now with that 200, 205. So able to pick up almost 8% more return with a bigger margin of safety, bigger upside cushion, less days to expiration. Why? Because of that huge jump in IV. Same thing on the put spread to the downside, right? Able to get basically almost double the price on the put spread with almost 6% bigger margin of safety, 10 points further out of the money, right? The 140, 135 now versus the 150, 145 back then. Back then, IV was at 33. Now it's over 70. So that 40-point jump in IV, and the skew steepened as well, as you can see, sets up ideally to take advantage of by selling a defined risk, right? We have our defined risk. Out of the money, we are now further out of the money now than back then, right? And shorter time frame, 12 days less, and able to pick up almost a 9% greater return now with a bigger margin of safety with less time to expiration. So hopefully sets up some trade ideas, whether you want to do a neutral sort of iron condor, a bearish call credit spread, a bullish put credit spread, or a straightforward covered call spread. Pick your strike. Do you want to leave more upside open, less, so forth? So certainly, but take advantage of that huge jump in implied volatilities we see here in Amazon finally starting to weaken, which is almost invariably the case always with implied volatility. So until next time, here's to good trading. Take care.